After the First World War, the German government had huge debts from the war and reparation payments to the Allies. Faced with striking workers, the government began printing money to be able to pay workers higher salaries. This gave the government more breathing space, but with workers getting more money, prices started to rise, meaning their higher salaries didn't really buy anything more. So the government just printed more money, creating this vicious cycle of rising prices, creating pressure to print more money. Within a few months, inflation got out of control. At the height of hyperinflation, you needed 4.2 trillion German marks to get a solitary dollar. Even a $50 billion mark was worthless. It was more worthwhile using banknotes as wallpaper or using burning money to keep your house warm. People would take barrelfuls of money to pay bills. If it was left unattended, the money wouldn't be taken, but the wheelbarrow might be. People who had saved all their life saw everything wiped out completely. It left a deep psychological scar, which arguably still influences German economic policy today. A simple explanation: if the amount of goods in the economy stays the same, but you double the amount of money in circulation, all things being equal, people will be willing to pay twice as much for those same amount of goods. Firms just double prices, and ceteris paribus, you get an inflation rate of 100%. Now, Germany is not an isolated case. In modern times, Argentina, Zimbabwe, all examples with very high inflation caused by creating money. But what about the UK and US? Don't they print money too? Could the big rise in national debt, which is forecast, tempt governments to pay it by increasing the money supply, causing runaway inflation? Well, in 2009, the financial crisis left the economy in the deepest recession since the 1930s, and central banks embarked on a policy known as quantitative easing. And this involves creating money electronically, literally out of thin air. And then the central banks buy bonds from commercial banks. But despite all this extra money in the banking system, it didn't cause significant inflation. By 2015, the US monetary base had increased 600%, but the consumer price index had only increased 15%. The monetary base is all that extra bank reserves at the central bank. It was the same in the UK. Inflation remained relatively low, despite the central bank creating all this extra money. But 13 years later, 2022, we did start to see the return of inflation. So was this just a delayed effect, or was it something else causing that inflation? Well, when a central bank creates money and buys bonds, it isn't actually printing money. The important thing to understand is it creates money for commercial banks who now hold more cash reserves with the central bank. Here's an important question. Between 2009 and 2015, when central banks were creating all this money, did any of it end up in your bank account? The answer was no. So on the one hand, more money was created, but it was not really reaching the average household. Now, some argue that quantitative easing helped to fuel asset inflation, because all of these cash reserves, banks were more willing to lend mortgages. Some people were able to buy stocks and things like that. Certainly UK house prices rose in that period. Quantitative easing had a limited impact, but there were also other factors pushing up house prices, notably ultra low interest rates. Now, this is the money supply in the UK. The monetary base is all those reserves held at the Bank of England and notes and coins. M4 is a much broader definition. It includes all the notes and coins, but all the different types of bank account and electronic money. Basically, quantitative easing didn't have much influence on this broader money supply, which is why it had a limited effect on inflation. By the way, the ONS states it was around £86 billion of notes and coins in circulation, but this only represents 2.7% of the total money supply. The entire money stock is £3.1 trillion. So the money supply these days is almost entirely electronic. And to a large extent, our money supply depends on the actions of commercial banks, not the government. Most money created is not done by the government printing money, but when a bank decides to create money by lending you a loan or mortgage or lending to a business. If banks don't want to lend, the money supply can contract. If banks get more optimistic and start lending more, then the money supply increases. What a central bank can do is try to influence bank lending through interest rates and, to a limited extent, quantitative easing. So if quantitative easing didn't cause inflation in the 2010s, what happened in 2022 when inflation around the world jumped close to 10%? Well, there are a few things to bear in mind. Firstly, when lockdown ended, there was a surge in demand for goods. But supply chains had slowed down during lockdown. Transport wasn't ready. There was a huge demand for ships, but they were in the wrong place or they were sold out. As a result, shipping costs soared, and this was passed on to consumers. Then in February 2022, the Ukraine war saw a surge in oil and gas prices. Now, oil prices have a very important impact on inflation because it affects so many prices, either directly or indirectly. You can see in this graph a very strong relation between oil prices and inflation. The great inflation of the 1970s was largely precipitated by oil price rises, although we did have wage inflation as well at the time. Thirdly, after lockdown, demand was relatively strong because stuck at home, many households had increased their savings. And when lockdown ended, there was pent-up demand. And don't forget that interest rates have been very low for a long time, very cheap to borrow. Central banks have got used to low inflation, and they were a bit slow to react when demand and inflation started to rise. They'd kind of assumed that inflation was no longer a problem, but suddenly it was. Now, remember when I said in 2009 quantitative easing didn't cause extra money into your bank account. But in 2021 and 2022, US households did see extra money coming from the government in the form of a stimulus check, literally money created and sent to households. And this contributed to some of the inflation in the United States. So this combination of more spending power, rising costs, higher oil prices all caused inflation. Also, many firms, especially in the US, took advantage of inflation to increase their profit margins. If costs go up 13%, why not round it up to 20%? So that was another bit of inflation too. Some call it profit push inflation. Now, some will argue that all the US inflation was caused by the government printing money, but this is only really part of the story. Firstly, countries which didn't have the same stimulus still had high inflation. Now, admittedly, Europe was particularly affected by higher gas prices. US monetary policy definitely did contribute to inflation, but it was also the rising oil prices and COVID disruptions as well. Now, another interesting example of inflation was in the late 1980s. Conservatives came to power in 1979, promising to reduce the very high inflation of the 1970s. In fact, they implemented monetarism, which is targeting the money supply to reduce inflation. This led to very high interest rates, higher taxes. Inflation came down, but at the cost of a very deep recession, very high unemployment. And by 1984, they'd actually abandoned monetarism because the link between the money supply and inflation was in practice very weak and unreliable. Anyway, in the late 1980s, the government believed they'd performed a supply-side miracle. Privatisation, deregulation, lower taxes. They all thought now the UK economy could grow at 4 or 5% a year. So they allowed the economy to grow quickly, interest rates were cut, asset prices soared, a lot of confidence, era of the yuppie, spending power going up. And the growth was really high, a quarterly growth of 2%, which is an annual rate of 8%. But when the economy grows too quickly, firms can't keep up. They put up prices, and we had a return of inflation. There hadn't really been any supply-side miracle, unfortunately. And the UK had to go through the old cycle of high inflation, putting up interest rates, and another recession, kind of a boom and bust cycle. And this actually led to the Bank of England being made independent in 1997. And it's fair to say for 10 years, central banks were pretty pleased with themselves because between 1992 and 2008, inflation was pretty low. Helped a lot, I have to say, by cheap Chinese goods, but also they did a reasonable job of managing the economy, at least in terms of inflation. Of course, there's always problems in the banks, but we can't go into that just now. Anyway, does high government debt cause inflation? Because in the case of Argentina, early 2000s, government debt soared, and again the government responded by creating money to help pay workers and help pay government spending. Similar story in Venezuela. Argentina, of course, had difficulty borrowing on external markets. And so this is a classic case of increasing the money supply again causing inflation. But not necessarily the case that higher borrowing does cause inflation. Japan has much higher debt than anyone else, and yet, if anything, they have the lowest inflation rate in the world in the past 20-30 years. In fact, they've been trying quantitative easing to actually increase their inflation rate and end that deflationary period. So, to summarise, if you increase the money supply in a way that reaches households faster than the economy can keep up, this is likely to cause some kind of inflation. Now, the complicated thing is that in 2009, quantitative easing was a very targeted increase in the money supply, which only really went to bank reserves with the Bank of England. It didn't really filter through into the wider economy. The broader money supply didn't really increase, and so it hadn't really any inflation. But there are different ways to increase the money supply. You can create all this electronic money, and then if you give it to households directly, then this will lead to higher spending, and it could well cause higher inflation. This was behind some of the US inflation in the 2022, but was also with other supply side factors like higher oil prices and COVID disruptions. So what's going to happen in the future? Will these massive predicted rise in debt lead to inflation? Well, no one really knows, because it depends how governments respond. But when governments have a collapse in the economy and they don't know what else to do, they can sometimes resort to printing money, creating money in a way that causes inflation. But quantitative easing has had less impact on inflation than many might imagine. So always be wary when someone says there's a very simple explanation for inflation, because in reality there's always quite a few different factors. And oil prices are often a big factor behind some of it, cost push inflation. Anyway, that's a bit on inflation. If you're interested in this, it might be like this video on why governments are fearing the bond market and how bond markets work, and that is related to inflation. Create too much money, cause higher inflation, bonds fall in value, and they need higher bond yield. Anyway, I hope that's not too complicated, but quite an interesting question, what causes inflation? There is still more to say, but I think that's enough for 12 minutes of explaining inflation. So anyway, thanks for watching, do subscribe, and we'll do more economic explained videos sometime. Cheers.